Tesla reported first quarter 2024 delivery numbers on Tuesday, and let's be honest, they were really bad. In total, production was 433,371 vehicles. Total deliveries was 386,810 vehicles. This is now a decline year over year. Not only has the growth narrative ended at Tesla, but also margins are probably going to be under pressure on a pretty significant level in the first quarter. So we could see the company now fall below legacy automaker margins. I think that would be a really shocking event for Tesla. This was always billed as a company that was going to be very high production growth, very high revenue growth, and also a very high margin company. But that has not played out over the last 5 quarters. So I want to dig into the trends and exactly what we learned from Tesla from the first quarter of 2024. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's go to the data directly from Tesla first. This is the release from Tesla this morning. You can see that production of Model 3 and Model Y vehicles, 412,376. About 21,000 other models, so that would include the Cybertruck, Model S, and Model X. In total, a little over 433,000 vehicles, but deliveries were just 386,810 vehicles. So I'm going to put some of these numbers into context. I'm going to pull some charts up on the screen. The first is a look at Tesla's quarterly production since the middle of 2021. You can see that over the last 6 quarters, production is essentially flat. This most recent quarter is actually the lowest production level that Tesla has had since the third quarter of 2022. But we're also seeing weakness on the demand side, on deliveries. Deliveries for the quarter were under 400,000. And now here's the shocking number. 46,561 vehicles were produced that were not delivered. Now, there can be a lag between when a vehicle is produced and when it is delivered, but typically when production is flat and when deliveries are flat, those things are going to even out over time. So you're not going to have a big difference between production and deliveries on a quarterly basis, on an ongoing basis, because that would be building inventory. But Tesla has been building inventory for 7 quarters now. You can see from this chart, this is the number of vehicles produced in excess of what they have sold. That totals 140,481 vehicles over the last 7 quarters. Now, this is starting to be a very significant number for Tesla, and this is not traditionally what we have seen from them in the quarters previous to that, in the years previous to that. They would bounce between building inventory and selling that inventory off, but there was not a big change. But there wasn't a big change on a quarter-to-quarter basis in the amount of inventory, but there's been a consistent build in inventory over the last nearly 2 years now. But that's not the only reason to be concerned. Yes, you want to increase deliveries for your Tesla, but you also want to increase deliveries at higher prices. And this is where I think there's a fundamental problem with the company's business and with the profitability of Tesla going forward. Tesla's prices have been dropping for well over a year now, and we're likely going to see the same thing in the first quarter of 2024. We don't have those numbers yet. I will add those to this chart when they come out, when quarterly results are released. But the trend has been that Tesla has needed to lower prices to move more vehicles. Now, there are a couple things that companies can do when demand drops. They can reduce their production, keep margins where they were, or they can lower their prices to try to move more product, keep those factories busy, and maintain profitability in that way. That's what Tesla has chosen to do. They've lowered their prices around the world, in China, in the US, and Europe, all over the place. There's more and more competition in the EV space, and Tesla has actually been leading that. But that's why this number is so shocking today. Lower sale prices have not led to an increase in demand. And I think what we're seeing is that Tesla has already reached the easy customers to reach. The customers that Tesla needs to reach now are customers that maybe need a different vehicle than Tesla offers. Maybe they need a different price point than Tesla offers. Maybe they just don't like Tesla vehicles. This is something that's different about a lot of technology products like smartphones and vehicles. You don't necessarily want to have the same vehicle as your neighbor. You want to look a little bit different. Everybody has maybe the same looking smartphone or very, very similar smartphone. And that's the way that that product has developed. But that's not the way that we have developed the transportation industry. And I don't think that's going to be the case in electric vehicles either. So Tesla may be pushing on a string in a sense from a demand perspective. there may be literally nothing that they can do but increase more models of vehicles. I don't think that the Cybertruck is the kind of vehicle that's going to sell at the levels of the Model 3 or Model Y, but they're going to have to increase their product offering if they're going to want to increase the number of sales overall. And this is, I think, the fundamental challenge with Tesla. It's either a high margin company or a growth company. It was going to be a real challenge to do both. Now maybe they've lost the thread on both of those things. Maybe this is not a growth company and it's going to be a lower margin company. And that would be a worst case scenario for Tesla and investors. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So there's a couple of things I think we need to think about with Tesla and where they sit today from an investment perspective. First of all, the stock is by any account very, very expensive. Just going to give you the stats right here. Enterprise value to sales multiple is nearly 6. A traditional automaker is going to trade for about 0.3 times sales. So it's about 20 times more expensive than a lot of competitors. Price to earnings multiple on a forward basis is 60. For comparison, traditional automakers trade about 4, 5, 6 times earnings. So over 10 times more expensive. And like I said, this is not a company that is even keeping margins flat. So the profitability and the free cash flow that Tesla had last year probably will be in decline in 2024. So I think that's a real challenge. There's also not a lot of new products coming out for Tesla. Yes, the Cybertruck came out last year. Yes, they've been talking about a $25,000 vehicle for a few years now, but we don't see any of those vehicles actually hitting the road in large numbers anytime soon. And the Model 3, Model Y, Model S, Model X are kind of the same looking vehicle. And that design is over a decade old now. The entire lineup really needs to be refreshed, and we don't see that coming from Tesla either. I think the thing that we need to think about with Tesla, and hear me out here because this is not something popular to say, but I think the numbers back it up, is that Tesla was a massive beneficiary of the pandemic. If you go back and look at Tesla's margins, which I think is the best indicator of an automaker's health and their pricing power, Tesla's margins exploded during the pandemic. And that was at a time when a lot of other automakers were short on supply. They weren't able to provide vehicles to people even at elevated prices. So there was an excess of demand versus supply. Tesla, as a result, raised prices and increased margins. What has happened since December of 2022, and that was specifically the time that Tesla started discounting their vehicles? Tesla's prices have gone down and their sales have been flat. It appears that supply is no longer a constraint. The market is back to normal. Companies are managing their supply like they would in a normal market environment. But Tesla still wanted to grow their supply and their deliveries, so they had to cut prices as a result. That's why you see margins continue to drop. So Tesla, massive benefit during the pandemic when there was a ton of dislocations in the auto market. And now that we get back to a little bit more normal environment, now you're facing normal competition. You're facing new electric vehicle makers, particularly in China, but also in the US and Europe. You're facing more ICE competition from vehicles that offer things that you can't. Trucks and SUVs are more compelling to a lot of parts of the country than Teslas are. And so this is the fundamental problem for Tesla, is it doesn't appear that the growth story is going to continue forever. They're now competing on a little bit more of a level playing field with a lot of other automakers, and competition is coming to the market. So unless something comes to the rescue, energy products, autonomous vehicle products, something artificial intelligence related, I think this stock has a long ways to fall. And that's just the reality for Tesla today. And this quarterly report showed that demand is the problem for Tesla. I think that's really clear right now. And investors just need to accept it. But what do you think about Tesla's quarter? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.